Hello again. Happy Tuesday. Markets aren't so happy, but well, that happens sometimes. So, as I mentioned last night, markets had come down and hit a pretty important level of support, and it wouldn't surprise me to have seen some type of a bounce to the upside. We got that for about the first 45 or so minutes of the trading session today. And then it all started to fall apart. And so therefore, when things start to fall apart after the kinds of downside days that we've accumulated that I showed on yesterday's graph, which I'll share with you again in a moment, we figured it was time to just be protective. So therefore, even though we were not heavily exposed to the equity market to begin with, again, somewhere to the tune of 30 to 50% was all that we had exposure to. We decided that it was time to become completely protective simply because the breach of the current support level suggests that we could have more to go. And after having analyzed markets last night and then after having seen how reactions took place early this morning, it was pretty clear that this bottom just does not look in. And that's being supported by really no fear in the system. No fear by the put-call ratio, no fear by the VIX level, you name it. So anyway, let me share my screens one more time, give you a quick depiction of what we're seeing, and then I'll let you know exactly how we're handling it. So yesterday, you might remember, we looked at the S&P 500, and we had said that this level of support was an area that we were feeling really good about, and of course it broke in a big way. As we analyzed last night and then into today, this thing here, yesterday's gap, as this is called, resembles what's called a breakaway gap. And when you have a breakaway gap on a market like this, it has a tendency to want to run harder to the downside. Some of the same things are true on the upside. For example, the most popular one would be a breakaway gap to the upside on Tesla. You can see this here back in October of last year. It had a huge move to the upside, a nice big strong upward gap, and look how far it ran. Now, is that to suggest that we're going to get the S&P 500 falling way down into these ranges? Well, not yet, but like anything, you work with the chart in front of you, you work with the market in front of you, and you deal with what you have at the time. And what do we have at this time? We have four very strong downside days that have accumulated in the last 22 trading sessions. Today, markets have broke below this level of pretty strong support. And realistically, the next level isn't down here until the 200-day moving average, which is, approximately another 5 to 6% below where yesterday's markets were. So we don't want to participate in that. And you can see this relative strength number down here keeps getting weaker. We're now below 35. A number below 35 on RSI is really suggestive of weakness. You couple that with the fact that the VIX, the fear indicator, is really not that elevated. I mean, when we go back and we start to look at the bottom that took place in 2018, the kind of fear that was required took us only up into the 35 zone. We're barely at 25 right now. That's not suggestive of the fear that you would anticipate with a 3+% downside yesterday, another 1% today. That's just not the kind of thing you would expect to see. So therefore, it feels very much like this wants to dip deeper. And because of that, we're just not going to participate. So we unwound the remaining positions that we had in the equity market. We are no longer in equities in any account, regardless of its risk level. For those who have had some bonds, those bonds exist. So for example, we still own this bond. We still own this bond. We still own this bond. Whoop, I'm not showing you my screens, am I? Sorry about that. Let me try this again. We own this bond. We own this bond here. This one here. This one here. And what we've done today is the assets or the capital that came from equities are going into intermediate term treasuries. And anytime this particular market was staying above this 113 level, we felt was pretty strong It gapped up above there yesterday. It's staying up above there today. And we anticipate a target of about 123 on this thing. So why is that? Well, if you take a look at interest rates right now, here's the 10-year Treasury yield. Let me show it to you on a weekly basis. The 10-year Treasury yield, as you can see, has been in a very long-term downtrend. I'll show you monthly. Long-term downtrend ever since the 80s. The way I always learned it was that a position will resume its trend after a consolidation. Well, here's about an 8-year consolidation of interest rates. And what's happening now? It appears that we're breaking down below this level that was set, the low in interest rates. We're at an all-time low in interest rates in the 10-year Treasury. And so could we go to zero in interest rates in the United States Treasury? Yeah. Could we go negative interest rates in United States Treasuries? Yes, we could. If that happens, then we're going to get a really nice rip to the upside in bond prices. So all those bonds that I just showed you, specifically speaking IEF, which is the intermediate term U.S. Treasuries, this thing is going to rip higher in the event we continue to see interest rates drop to the downside. And it would certainly appear that interest rates are slated to keep coming lower, especially if the Fed decides to come in and cut rates. As I mentioned yesterday, it's highly possible that a cut in rates that comes from the Fed could result in an equity market selling off even harder, because it's possible that bad news is viewed as actual bad news. Sometimes bad news in the market's viewed as good news because the Fed comes in, cuts rates, creates tons of liquidity, and stocks love that. At some point, that stops working. The markets right now appear to not believe that the Fed is either going to come to the rescue or come to the rescue until there's much more pain. How much more pain? We don't know, but I don't want to mess around with it, and I don't want to participate in that. Right now, today's downside move, which is currently about 1.3% on the S&P 500, is registering about an 80% downside day, which means 80% of the stocks that are declining, 80% of all the volume is in those stocks. It's heading lower. So therefore, we've taken a protective position. We have coupled that with an opportunity to make some money in the bond market with intermediate term treasuries, symbol IEF, and that's what we're going to sit and hold on to for the foreseeable future. What we're waiting for, of course, is a market to ultimately bottom, and one thing I don't want to do is catch a falling knife, as they say. So we're not going to sit in equities and wait. We're going to just remove ourselves from that scenario, hold on to IEF until we get a clear turnaround in equities. And that would mean that we would see at least a back-to-back 80% upside day in the S&P 500, NASDAQ, things like that. So until then, we'll just keep paying attention. And I just want to let you know we're not at this point in time taking any risk in markets as it relates to stocks and equities. The near-term risk, as I showed you with this one chart with the S&P 500, this right here, the near-term risk, is fairly high. And I just don't want to take high degrees of risk at any time if we can help it. So if you have any questions, by all means, give me a call, 608-354-1977. Shoot me an email, chris@careformywealth.com. If you happen to have a 401k that is away from our custodian at E-Trade, at your company, your work, or whatever it might be, and I'm helping you monitor it, please know that I'm sending you an individual email as to which fund to select right now based on this protective stance that we're looking to take. Okay, thanks again. Have an amazing day.